Hello, and welcome to Boni's Life, the channel where we dissect the unseen forces that shape our world. Today, we're diving deep into a topic that separates the consistently successful from the perpetually struggling in the high stakes arenas of trading and tech investing: mental models. Have you ever wondered why a small handful of individuals seem to make brilliant decisions time and time again, while the vast majority of us are left grappling with uncertainty and often regret? It's not just about luck, and it's certainly not about having a crystal ball. The secret lies in how they think. They've cultivated a set of powerful mental models that allow them to see the world not as it appears, but as it truly is. In this episode, we're going to pull back the curtain on the decision-making frameworks of the world's most successful traders and tech investors. We'll explore the mental models they use to navigate complexity, manage risk, and identify opportunities that others miss. And more importantly, we'll uncover the information that mainstream media often filters out, the inconvenient truths and the contrarian thinking that are the hallmarks of true genius. So, if you're ready to upgrade your thinking and make better decisions in your own life, you're in the right place. Let's get started. First up, let's talk about a mental model that's as fundamental as it gets: first principles thinking. This is the art of breaking down complex problems into their most basic foundational truths. Instead of reasoning by analogy, which is what most of us do most of the time, you reason from the ground up. Think of it as deconstructing a complex dish into its raw ingredients. Only then can you truly understand how it's made and how you might create something entirely new. Elon Musk is a modern-day champion of this approach. When he wanted to build rockets, he didn't just look at the price of existing rockets and try to make them a little cheaper. He asked, what are rockets made of? The answer: aluminum alloys, plus some titanium, copper, and carbon fiber. Then he asked, what is the value of those materials on the commodity market? It turned out that the cost of the raw materials was only about 2% of the typical price of a rocket. This insight, born from first principles thinking, was the genesis of SpaceX and its mission to dramatically reduce the cost of space travel. This is a powerful concept that extends far beyond rocket science. In investing, first principles thinking means questioning the assumptions that underpin a particular stock or market trend. Instead of asking, is this a good company? You might ask, what are the fundamental drivers of value in this industry? What are the unchangeable laws that govern its success? By stripping away the layers of conventional wisdom and market noise, you can arrive at a much clearer and more accurate understanding of the investment landscape. Now, let's layer another powerful mental model on top of that: second-order thinking. This is the practice of thinking beyond the immediate consequences of a decision and considering the long-term ripple effects. It's about asking the question, and then what? Most people operate on the level of first-order thinking. They see a problem and they grab for the most obvious solution. They make a decision based on what feels good right now, what will bring the quickest reward. But the world is a complex, interconnected system, and every action has a reaction. Second-order thinking is the ability to anticipate those reactions. Howard Marks, the legendary investor and author, has written extensively about the importance of second-order thinking. He argues that in the world of investing, it's not enough to have an opinion. You have to have an opinion that is different from the consensus, and you have to be right. To do that, you have to see things that others don't see. You have to think about the consequences of the consequences. For example, a first-order thinker might see a company's stock price falling and think, I should sell. A second-order thinker might ask, why is the stock falling? Is it due to a temporary setback or a fundamental flaw in the business? If it's temporary, this could be a buying opportunity. What will happen if I buy now and the market recovers? What will happen if I'm wrong? This deeper level of analysis is what separates the amateur from the professional. This brings us to another cornerstone of intelligent investing: a mental model championed by Warren Buffett and his partner Charlie Munger, the circle of competence. The idea is simple, yet profound. You don't have to be an expert on everything. In fact, you're far better off if you're not. The key is to know the boundaries of your own knowledge and to stay within them. Buffett uses the analogy of a baseball batter. The best hitters don't swing at every pitch. They wait for the one that's in their sweet spot. In the same way, The best investors don't try to understand every company or every industry. They focus on the ones they can understand, the ones that fall within their circle of competence. As Buffett himself has said, the size of that circle is not very important. Knowing its boundaries, however, is vital. This is a powerful antidote to the overconfidence that plagues so many investors. It's a recognition that it's okay to say, I don't know. In a world that rewards the appearance of certainty, this is a radical act of intellectual honesty. It's also a crucial component of risk management. When you venture outside your circle of competence, you're no longer investing, you're gambling. And speaking of risk management, let's talk about the margin of safety. This concept, popularized by Benjamin Graham, the father of value investing, is about building a buffer against the uncertainties of the future. It's the idea of buying an asset for significantly less than its intrinsic value. This difference between price and value is your margin of safety. Think of it like building a bridge. If you expect the bridge to carry a maximum load of 10,000 pounds, you don't build it to withstand exactly 10,000 pounds. You build it to withstand 20,000 or 30,000 pounds. That's your margin of safety. It's what protects you when things don't go as planned, when the future turns out to be different from your forecasts. In investing, the margin of safety is your protection against errors in judgment, bad luck, or the unpredictable gyrations of the market. It's what allows you to sleep at night, even when the market is in turmoil. A larger margin of safety not only reduces your downside risk, but it also increases your potential for outsized returns. When you buy a great business at a fair price, you can do well. But when you buy a great business at a wonderful price, that's when you can achieve truly extraordinary results. Now, let's consider a mental model that is often overlooked, but is a favorite of Charlie Munger: inversion. Instead of asking how to achieve a goal, you ask what you should avoid. Instead of thinking about what you need to do to succeed, you think about what you need to not do to fail. This simple twist in perspective can be incredibly powerful. It forces you to identify and sidestep the pitfalls that can derail your progress. As Munger says, it is remarkable how much long-term advantage people like us have gotten by trying to be consistently not stupid instead of trying to be very intelligent. In trading, for example, instead of focusing on how to make a lot of money, you might focus on how to avoid losing money. This would lead you to prioritize risk management, to cut your losses quickly, and to avoid taking on excessive leverage. In the world of tech startups, instead of obsessing over how to build the next unicorn, you might focus on how to avoid the common mistakes that cause most startups to fail. This would lead you to validate your ideas with customers, to manage your cash flow carefully, and to build a strong team. Now, let's talk about the elephant in the room: the mainstream media. We're constantly bombarded with financial news, market commentary, and expert predictions, but how much of it is actually helpful? And how much of it is just noise, or worse, actively detrimental to our financial well-being? The uncomfortable truth that the mainstream media won't tell you is that their business model is not aligned with your best interest as an investor. Their goal is to attract eyeballs, to generate clicks, to keep you hooked. And the best way to do that is through sensationalism, fear, and greed. They amplify the noise, they create narratives, and they prey on our most basic psychological biases. One of the most pervasive of these biases is herding. We are social creatures and we have a natural tendency to follow the crowd. When the market is soaring, we feel the urge to jump on the bandwagon. When it's crashing, we feel the pressure to sell with everyone else. The media feeds this instinct, creating a feedback loop of fear and greed that can lead to bubbles and crashes. Another powerful bias is confirmation bias. We tend to seek out information that confirms our existing beliefs and to ignore information that contradicts them. If you're bullish on a particular stock, you'll gravitate towards the articles and analysts that share your view. The media knows this, and they cater to it, creating echo chambers that reinforce our biases and prevent us from seeing the full picture. And then there's loss aversion, the tendency to feel the pain of a loss more acutely than the pleasure of an equivalent gain. This is why it's so hard to sell a losing investment. We hold on, hoping it will come back, even when the evidence suggests it won't. The media exploits this fear with headlines that scream about market turmoil and potential losses, triggering our most primal instincts and leading to irrational decisions. So, what's the antidote to this toxic cocktail of media manipulation and psychological bias? It's to cultivate a healthy skepticism, to question the narratives, and to do your own thinking. It's to recognize that the news is not a reliable guide to investment success. In fact, the more you can ignore the day-to-day noise of the market, the better off you'll be. Now, let's turn our attention to the world of tech, where a different breed of investor has emerged. These are the visionaries, the builders, the ones who are not just playing the game, but are actively creating it. And they have their own unique set of mental models. Take Jeff Bezos, the founder of Amazon. When he was deciding whether to leave his comfortable job on Wall Street to start an online bookstore, he used a framework he calls the regret minimization framework. He projected himself forward to the age of 80 and asked himself, "Will I regret not having tried this?" The answer was a resounding yes. He knew that he would always wonder what if he didn't take the leap. This long-term perspective is a hallmark of his decision-making. And then there's Elon Musk, who we've already mentioned. His reliance on first principles thinking is legendary. But it's not just about breaking things down, it's about having the courage to rebuild them from the ground up, to challenge the assumptions that everyone else takes for granted. It's a mindset that is constantly asking, is there a better way? What these tech titans have in common is a willingness to be different, to be misunderstood, to be a contrarian. And that brings us to one of the most important and most difficult aspects of successful investing, the psychology of going against the crowd. Contrarian investing is not about being different for the sake of being different. It's about being right when the consensus is wrong. It's about buying when others are fearful and selling when others are greedy. It's a strategy that is simple in theory but incredibly difficult in practice. The reason it's so difficult is that it goes against our most basic human instincts. We are wired to seek safety in numbers, to conform to the group. When you take a contrarian position, you are, by definition, alone. You are standing against the tide of popular opinion, and that can be a very uncomfortable place to be. This is where emotional resilience becomes so critical. It's not enough to have a brilliant investment thesis. You also have to have the fortitude to stick with it, even when the market is telling you you're wrong. You have to be able to withstand the psychological pressure of being in the minority, of watching your positions go against you, of being ridiculed by the so-called experts. So, how do you cultivate this kind of emotional resilience? It starts with having a deep understanding of your own psychology, of your own biases and blind spots. It's about developing a set of principles and a framework for decision-making that you can rely on, especially when your emotions are running high. It's also about having a long-term perspective. The market is a voting machine in the short run, but it's a weighing machine in the long run. In the short run, prices can be driven by emotion, by narrative, by the whims of the crowd, but in the long run, they will ultimately reflect the underlying value of the business. And finally, it's about having the humility to know that you can be wrong. The best investors are not the ones who are never wrong. They are the ones who are quick to recognize their mistakes and to correct them. They are constantly learning, constantly adapting, constantly updating their mental models in the face of new evidence. So, there you have it. A glimpse into the minds of the world's most successful traders and tech investors. As you can see, it's not about having a secret formula or a magic crystal ball. It's about having a latticework of mental models that allows you to see the world with more clarity, to make better decisions, and to navigate the complexities of the market with greater skill and confidence. From first principles thinking and second order thinking to the circle of competence and the margin of safety, these are the tools that can help you to cut through the noise, to avoid the common pitfalls, and to identify the opportunities that others miss. And by understanding the psychological biases that can lead us astray and the manipulative tactics of the mainstream media, we can protect ourselves from the irrationality of the crowd and chart our own course. But here's the most important takeaway. These mental models are not just for billionaires. They are for anyone who wants to think more clearly, to make better decisions, and to live a more successful and fulfilling life. They are tools that you can start using today in your own investments, in your career, and in your personal life. So I encourage you to start building your own latticework of mental models. Read widely from different disciplines, question your assumptions, think for yourself, and above all, have the courage to be a contrarian, to be different, to be you. Thank you for joining me on Boni's Life. If you found this episode valuable, please give it a thumbs up, subscribe to the channel, and share it with someone who you think would benefit from it. And in the comments below, I'd love to hear your thoughts. What are some of your favorite mental models, and how have they helped you to make better decisions in your own life? Until next time, stay curious and keep learning.